All right, everybody. Welcome to our Tuesday news update. Um, there's some there's some very interesting things going on right now. Almost mixed messages. We're going to cover two big topics about credit cards and about interest rates and how they're going to be affecting what's happening in the credit card marketplace, as well as some of the things Congress is pushing really, really hard for to benefit borrowers. So, the first kind of broad announcement is if you haven't heard yet, student loans, the moratorium on student loans have been extended until January. So make sure that those share this, love, share, get the word out there. If you've got students or folks who are in the student loan and have student loan debt, make sure that they get this so that they can see that student loans have been extended. The moratorium has been extended until January. Now, two things that are happening. Remember, we talked about in the last couple of weeks. We talked about that during the pandemic, people were just paying off credit card debt like crazy. It was almost worrisome for lenders. Well, that was short-lived because in second quarter there was a huge surge in public spending, especially among credit card holders. According to a new survey, 62% of Americans said that their credit card debt has increased actually over since the pandemic began. And 52% of those respondents said that they use their credit limits to support their lives in the middle of the pandemic. So this is the consumer spending is not slowing down. And as we go into this, what some are calling the W recovery, right? We down into the pandemic, a little bit of the spring, a little bit of a rise. Looks like this fall we're heading back down in with the Delta variant, and hopefully a rise as soon as possible. Well, additionally, credit card banks are counting on the credit card transactions and debt to regain their pre-pandemic status. In fact, household debt has jumped in Q2, jumped more than ever before in the second quarter for 14 years. It's been 14 years since there was this much of I don't want to use the term spending spree, but the use of credit cards to move the American households forward, right? And so now there's two really powerful movements. People are trying to get out of debt because of a tenuous working W-2 tenuous job, or the likelihood of their jobs continuing. So there's a huge move to get out of debt, and yet half of the other half apparently are now spending, and in second quarter of 2021 have spent more in a quarter than they have in the last 14 years, or in one quarter than they have in the last 14 years. So that's on the credit card side. Then banks are making a move, and mostly tier 2 banks. When I read the list, PNC, TD Bank, Fifth Third, Huntington Bank Shares, Regions Banks, these big tier 2 banks have been reducing and or eliminating the overdraft fees if somebody like bounces a check. Those credit unions are $25, $30. It's been $35 to $45 for these different banks, and the Congress has been pushing hard to remove completely or significantly lower those bank fees, because they say that it's regressive against folks with less financial sophistication. So they bounce a check more often, and those fees are now eating up a significantly higher percentage of their small income. And so they're looking to build programs. The banks are responding with new programs with special types of checking accounts that don't include these fees, but may have may backstop with certain cash reserves, small amounts, $100, $200, things like that, so that basically you're covering your own you're backstopping your own fees. Now, in our boot camps, we talk madly about what we call the new zero. There's how to create stay as far away from zero in your checking account as possible, because overdraft is one of the big funding landmines that literally will take you out of the funding game. And for a minimum of 3 months, most likely 6 months from the date of the last bounce check. The idea being that if you don't manage your own resources well, how are you going to manage the bank's money? So that is the like I said, Congress has been making a move for a while on this, and banks are responding in kind. Now, the next thing that that Congress is pushing hard on is to cap interest rates nationwide. Cap interest rates at 36%. Now, this is mostly aimed towards the payday loans and the title loans, where you're paying 36% a week, 68% a week, where the fees and the interest is 2 or 3 times than the original amount loaned. I fully support this one because it is regressive for the folks who need title loans. They're usually the what we call the invisible borrowers, right? The invisible credit market, and it is highly regressive. So I'm going to say sorry to all the payday loan folks out there, but 36% is still, you can still make money with as a business model. But those interest rates nationwide, it's really just an expansion of the what was called the Military Lending Act of 2006, which made 36% the max for all veterans on consumer loans, payday loans, installment loans, etc. Well, now they're expanding that to and developing what's called the Consumers Fair Credit Act, which it kind of leverages the experience over 15 years now. The military has had a max cap of 36%, and they want to apply that to all borrowing across the country. All borrowing across the country. All right. The final thing for our discussion today is we want to make sure, we've been talking about digital banking, right? Opening up a checking account online, video conferencing with a banker instead of just phone calls, having those interviews with banks, a business banker online. Well, Chase did a study itself, besides all the other studies that are going on out there. Chase did an in-house study, and which highlights the popularity of digital banking, especially among Gen Z and the lower half of the younger millennials. The whole idea is whatever banking one can do on their phone, the more influential it is, and the more attractive it is to Gen Z and younger borrowers. Now, these digitally active customers, Chase reported there's almost 57 million digitally active customers, and that's been a 10% increase year over year for the last 3 years. So you heard it here first. There is so much movement towards digital banking, but remember, we still want to work with tier 1 and tier 2 banks with our credit cards, and our to develop relationships with tier 1 and tier 2 banks, because those banks are the ones who are going to use automatic underwriting in most of their lending decisions, and we want to be in charge of our own approvals, and that's what fundability optimization is all about. This is Merrill Chandler. Thank you for joining me today on our news update, and we will catch you same Fundable time, same Fundable channel next week, Tuesday, noon 30 Mountain Time. Be sure to share, like, love, send hearts, tell people about the amazing things that are happening in the marketplace, and be the one to share it with them. We will see you